Is inflation rising? Well, we're looking at the calendar right now of data releases this week. And so on Tuesday, we have the Consumer Price Index for February. I read a report, which I thought was quite amusing, that said that inflation's going up. Gasoline prices are increasing, and service price inflation might be more stubborn than what people were thinking, and so on. So I want to talk a little bit about inflation. So our narrative all along for case A scenario, where we look at things like non-traded sticky price inflation, is that underlying inflation is still quite high, that people have been fooled, effectively myopic people, because they look at measures of headline inflation and other measures of inflation like the core PCE and those measures, as well as things like quarterly earnings and the employment cost index, include tons of measurement error when we think about what underlying inflation is. Now, financial markets, unfortunately, have also fallen into that narrative. So I want to talk a little bit about how this works in financial markets and how I think about it. So I always think that there's a group of what we would describe as myopic people in the population, and they engage in financial markets. They have what Robert Schiller describes as a narrative-based approach. I don't know why humans yearn for narratives or stories about what is going on, but in a lot of cases, that takes very complicated issues and simplifies them into a simple story. So the problem is that there's way too much attention on these narratives that are being pushed by what I would describe as the myopic crowd that isn't thinking very deeply about the issues of what inflation is and what causes inflation, or put more precisely, what we know about inflation, I think, in the economics profession. So I'm going to take you through what I mean by that. So first thing is, don't believe anything. Everything could be false. And so in this article, they talked about gasoline prices. Well, that at least we can verify by looking at the source data on gasoline prices, retail gasoline prices, because they get the data in the CPI. So we already have the data for February. We're looking at an important component of that, which is regular gasoline prices, and you can see that they increased from in the picture from $3 and 75 cents per gallon to $3 and 21 cents, and so that's an increase of 4%. Well, those kinds of things that have what we call refined petroleum products represent about 3% of the CPI. So this is up, right? This number right here is up by 4.4%. Okay, and the weight of those kinds of things that are being driven by oil costs. So oil crude costs have gone up. That represents like about 3% of the U.S. CPI, right? So we just multiply those two numbers together, and we got 0.1, a whole decimal point. So inflation will rise by 0.1 because of this effect. Now, surely when we think about inflation, we have to think beyond this. This is what we would describe as a proximate, not approximate, but approximate cause of inflation. And in fact, central banks, by not understanding what proximate causes of inflation were in the 1970s, when we had things like high oil prices in the 73, 74, with the price of oil quadrupled and stuff, they started talking about inflation being driven by these, by these shocks. But fundamentally, the cause of inflation is bad monetary policy. And so central bankers, when they're talking about things like oil price shocks and stuff like that, they better have monetary policy in that story too, because failing to respond adequately to these kinds of shocks can mean that inflation expectations can ratchet up like in the 1970s and so on. So the first thing is, yes, we verified prices are up by by over 4% in February, and that should affect the CPI. Now the question is, how much do we care? Well, look at the graph of gasoline prices, and so what we're talking about is this little tick up. So that's like that's 4%. But so just put that into a historical perspective, and look at oil prices during the period where basically everybody in the world failed to realize that the underlying trend in oil prices was up in this period right here. So let's remember that China joins the World Trade Organization. The demand for oil rises, but fundamentally, what was happening is that the oil supply was disappointing, and this, in the Energy Information Agency's forecast, inside the International Energy Agency, inside virtually everybody's forecast, they failed to realize that the oil that was depleting in the existing fields was not sufficient. Well, meant that we needed a lot more oil. Now, of course, the model that we developed has this idea that oil can get harder and harder because of that. Okay, but that when the price of oil rises, that then incentivizes, obviously, a high price of oil incentivizes improvements in technology to get at oil and to take not only to get at the oil, but to be able to take it to a market and so on. So obviously, with the development of shale oil, that then pushed us into another regime where oil prices were stable, and so that was a very important part. And then, of course, there was this period where then oil prices, the oil market went a little bit more into balance, and then 2015 we had a dramatic reduction in the price of oil, and then more recently you can see that basically it increased during COVID, and then it's come down. But I just want to emphasize very very small little, this 4% here, this little movement at the end is nothing. Okay, so just to put that a little bit into perspective. Okay, so the story is, what about inflation? And the answer is, look at sticky price inflation on the Atlanta Fed website. It is between 4 and 5%. Look at, again, the Atlanta Fed website, and you'll see that the wage tracker is about 5%. And so if we think of productivity growth as being somewhere between 1 and 1.5%, the wage number would suggest that maybe underlying inflation is about 3.5%. Non-traded sticky price inflation would have it between 5 and 6. So I'd say the best estimate that I would have would be somewhere in between how much labor costs are growing how much unit labor costs are growing and how much not traded sticky price inflation is. And that's just bottom line is that is significantly, both those measures are significantly above measures of the core PCE. And so if you buy this, the March release that will be on Tuesday for February should start to show some upward surprises, not only in March, but in April and May and June and so on. Now, I should emphasize this, that unfortunately, this is more complicated because there's obviously a random aspect to this. So when we say that there will be a tendency for underlying inflation measures like core PCE to rise and in the future, we say that conditional on there being a scenario where the U.S. economy continues to run hot, that we don't have a major economic downturn and crash in equity prices and crisis in confidence and so on. But barring those kinds of case B types of scenarios, it looks like we're probably going to observe some positive surprises on inflation going forward. So I hope that you're prepared for that. Higher inflationary surprises means that people will take capital losses on their long-term bond portfolios. And historically, positive inflation surprises that have been significant are bad for equities and so on. So again, the last video, we argued that there is a humongous asset price bubble. The S&P looks like if it stayed at where it is today until the end of the month, it will be up 8% since the end of last year. So this will be another whopping several $1 trillion increase in the household balance sheet, which at the end of last year was a whopping $43 trillion higher than the annual production of goods and services in the U.S. economy in 2019. So these numbers are staggering, and with the S&P at its current level, we could have several $1 trillion increase in the household balance sheet. So we have some empirical results that suggest that obviously disposable income in this measure of household wealth is driving consumption. And so if the market stays this hot, forget about the labor market showing any signs of cooling. And so with wages and non-trade sticky price inflation up at those kinds of levels, it's very likely that that underlying inflation will stay high and will require either increases in the Fed funds rate or certainly putting off declines in the Fed funds rate. And so stay tuned. We're going to be talking about these issues on Tuesdays and Thursdays in the Better Policy Project seminar series. So this is a seminar series on Tuesday it happens, and Thursdays it happens at 2 p.m. London time. And you can sign up for that seminar series by going to the Better Policy Project website at www.thebetterpolicyproject.org. So I'm Doug Laxton, wishing you a nice evening.